Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 242, 5 Financial Pitfalls to Avoid. Matthew, thank you for joining me back on another episode of Upticks.
Of course, it's my pleasure. Thanks so much for having me again.
Yes, and you're subbing in for Corey. Good for Corey and Cassie. They are on vacation or headed to Arizona today to check out beautiful Sedona. So for our clients that have been out to Sedona, I'm sure Corey will have lots of memories and stories to share with you. So Matthew's subbing in while Corey's knocking off. You and I are doing the hard work, which is producing good content for our audience and our clients. Now, Matthew, you've got some important news. Have you been on the show since you've been married?
No, this is my first show as a married man.
All right. So, ladies, he's no longer available.
Oh.
He's officially married. I attended the wedding. You and Jordan have some excellent family and friends. It was a wonderful evening. A lot of great stories and great speeches. But why don't you share with the audience, Matthew, a little bit about your honeymoon? Because I know you guys went to somewhere pretty cool.
Yeah, the wedding and honeymoon, they both perfect. We couldn't ask for more, but we went to Sonoma in California, so wine country. We were there for about 5 to 6 days. It was beautiful. We've never been to California before, so all the scenery, everything was green, the mountains. It was very beautiful, and of course, we enjoyed a lot of good wine. So we're planning on definitely going back to Sonoma, but we stayed in Healdsburg, which is more towards the north end of Sonoma. And it was just beautiful. We just loved it so much. We're already talking about planning on, going back for another vacation in the near future. So it's definitely going to be an expensive a trip.
Yeah, nice. And do you have a favorite vineyard that you guys visited? Because I know you toured several vineyards.
Yeah, our two favorites were Silver Oak and Jordan. Both of those we had kind of like a sentimental attachment to. Plus, they just make fabulous Cabernets there. So those were our top two.
Yeah. And did you guys check out, did you go to like French Laundry or any of the famous restaurants out there? Or did you have like a good meal that you're like, man, this is really good?
We tried to get into French Laundry, but I was trying to book it in like January. We went in March. It was already booked up, but we had, I think, 2 Michelin star restaurants. So we ate really good. All the food was fantastic, but we didn't get into some of those, 3 or 4 star Michelins. I think it only goes up to 3 stars, but I'm kind of glad we didn't get into it because the meals I looked were outrageous. So, but it would have been a treat.
I got to share a quick story with that. So Rachel and I have been to Sonoma one time as well. We had a great time up there, and somehow, what I did is I got us on the wait list, right, for French Laundry, right? So we were on the wait list for like a lunch or some weird time, and we had gone to some vineyards or did a bunch in the morning, and so we literally like took a nap, and I missed the phone call. French Laundry called me, and we could have gotten in, but I missed it. I called them back, and they're like, "No, you're off the list now. You missed our phone call." So I had it. I was right there. I had a chance to go, and I snoozed. You snooze, you lose.
Wine will do that to you. So
yeah. But it is beautiful. You're right. We really enjoyed it out there. I need to take Rachel back. So good. So congrats on the wedding and the honeymoon, and we're glad to have you back in our new office. So again, you're in your new office today recording. I'm in my home office. I'm recording this on a Wednesday. On Wednesdays, I allocate time for research and development, and this is part of that is recording Upticks. And for today's topic, you and I wanted to talk about something very important, which are 5 financial pitfalls to avoid. We meet with hundreds of people every year, and we have a lot of different conversations, and we see a lot of pitfalls that people sometimes can get trapped in, and our job is to help avoid that or help people get out of some mistakes that they've made. So you and I wanted to go into that today. But before I do that, a quick plug for Upticks. Thank you to everyone that has subscribed. We're approaching 250 episodes which is really exciting and really cranking these things out. Okay, so for today's topic, Matthew, as you're my guest, I'll let you kick it off with number one.
Of course. So this first one, I feel like it's pretty basic. Everyone knows that they should have this, but it's something that they, usually don't do for some reason. But that is to have an emergency fund or excess liquidity on the side. And the reason why that's a potential pitfall if you don't have an emergency fund is that because life happens, things are going to come up, your car's going to break down, you might have, a hospital bill, something of that sort. And if you don't have that emergency fund or, liquidity on the side, you might have to, one, sell stocks while they're down in value and lock in a loss. You might have to take on debt. So you might use your credit card. And if you don't pay the credit card off in time, credit cards interest rates, they can be north of 20%. So that debt could cost you a lot. Or you would have to go and try to get, a small, or a small loan, but that could have origination fees and also a high interest rate. So having that emergency fund liquidity, it just gives you that buffer for when life happens.
Yeah, that's a really good one, Matthew. Yeah, so number one is got to have some cash on hand for those emergencies, whether you're working or retired. You bring up a good point, especially for even someone that's not retired or for the investor. People get so caught up in stock market volatility. If you have your short-term cash needs on hand, whether that's in your checking savings account, maybe you have treasury bonds, or maybe you just have bonds with us, and you have all that allocation structured, what the day-to-day fluctuations in the market really should not matter to you. And so that does trickle into the investing side, but also if you're working, you don't want to have to use your credit card for an emergency, unless you can pay it off, obviously, immediately. And you don't have to go get one of those sketchy payday loans or something, right? You don't want to have to go down that route. It's a snowball, it's an avalanche, it's slippery. So again, pitfall, let's make sure you've got enough cash for that emergency. If you're retired, let's make sure you have enough cash and bonds so that you don't have to worry about that day-to-day fluctuation with the market. Good one, Matthew. So I'll kick off with number two, and that's separating your emotions from your financial decisions. Fear and greed are huge drivers of just being human. And it's okay to have fear and it's okay to be greedy, frankly. But you don't want to have those emotions dictate what you're doing with your financial plan. That's where we see people get in trouble. They get really scared and they want to cash in all their investments because the market's down, or they see their neighbor made money in a hot stock and they want to go put all their money in that stock. So you got to be very careful. You want to separate from those emotions. You want to embrace them, and you don't want to make any decisions under that emotional state. And that's why you hire your friends at Falcon Wealth Advisors, is that we're going to be that unemotional third party that's going to let you experience what you're experiencing, and then we're going to go over the facts and go over the plan. Matthew, do you have anything you want to add on number two?
No, I think that's very much real. We actually spoke of a client yesterday, a potential client, Jake, where she said she was paralyzed with what to do for her investments just because she was worried about making a mistake. It was very emotional for her. I'll throw you a curveball. What tips or advice do you have for keeping emotions out of investing there?
Yeah, I mean, first you want to recalibrate. So if you're experiencing extreme emotion, you want to take some deep breaths. Maybe do a brief meditation, literally, and take a step back. And then what I encourage people to do is to zoom out and look at the bigger picture. For many of our clients, we're still averaging them 6, 7, 8, 9% a year as far as their investments are concerned, even though they had a very bad negative year last year. So to help with those emotions, you want to take a deep breath, try to recenter yourself, and then zoom out and call us or set a meeting. That's probably the best thing you do, is like, okay, let's talk with Matthew and Jake or Corey, right? Someone at Falcon Wealth Advisors. Let's take a look at my performance and how am I really doing as it relates to the big picture. And then I think the next step on that would be, let's look at your financial plan. Does that trajectory in your financial plan still look healthy? Really, those are probably the two number one things that I would do. What about you? What tips would you have for someone to separate their emotions?
Yeah, those were good. I've heard you say this in quite a few meetings, but this too shall pass. So that kind of, as you mentioned, just thinking long term, just because we know short term, there's always going to be ups and downs. It's, life's a roller coaster. So is the stock market there. So just gotta have that, end goal in mind and think long term.
Yeah, that's really good. Yeah, because when there's a war going on with Russia and Ukraine, people think that'll never end. Inflation is hot; they think it's never going to end, right? And things cycle; things go in and out of favor, things go up and down. So you've got to roll with it as it happens, and realize there's another crisis around the corner. We had the pandemic; there will be something else. Sadly, that's just life, and that's human nature, and that's what happens. Good, good. What's number 3 for us?
Yep. So on the note of financial planning, I would say the third pitfall that we see is people not saving enough for retirement. So there's a lot of different articles out there on how much you actually need to save for retirement, but everyone's number is different. So you might think that you're on track, but based off your lifestyle, you might actually need more or less than what the article says. So I would say not saving enough. You really want to make sure, especially if you're younger, to try to save anywhere between 10 to 20% of your income, but potentially more based off your financial plan and your lifestyle there.
Yeah, that's really good. I always tell people save early, save often. If you don't have your money aligned with your values, that's where typically people fall into trouble. They're like, well, I can't afford to save anymore. That's when you need to take a look at your budget. And are you wasting money on coffee or car payments or whatever, right? On Amazon, like all of us are probably. Like, are you spending on frivolous things that is allowing or not allowing you to save appropriately? So you want to make sure that's the best thing you can do if you're working. And even if you're retired, I think you made a good point of saving when you're younger. But even as a retiree, I think it's just managing that cash flow, not necessarily saving, but making sure that things are properly aligned. That's good. All right, perfect. So number 4, I have number 4 pitfall to avoid would be avoid chasing fads. And what I mean by fads are, I remember back in the day, 3D printers were like a big deal. People wanted to invest in. Cryptocurrency's been a big one. Marijuana stocks has been a fad. There's meme stocks, right? These stocks that were hyperbolic, even though they were pretty much poorly run companies. You've got these, what are they? The AMTs, or what are the AMTs? The
NFTs, yeah.
NFTs, yeah. The NFTs, non-fungible tokens, that are certainly worth. I mean, you literally could buy sports playing cards, or it's a file, it's a computer file that you could spend thousands of dollars on for literally a picture. It's not even art; it's like a picture of something. So don't chase these fads. You want to stick with the tried and true singles and doubles. Invest in companies that are growing their earnings, growing their dividends, and hopefully are going to be around for decades and decades and decades. So don't get caught up in what your neighbor's brother, sister's dog bought and got rich overnight. Sure, that stuff does happen, but it doesn't happen to everybody, right? And so occasionally people get lucky, occasionally people win the lottery. But I don't tell my clients to go spend $1,000 a week playing the lottery. It'd be a bad idea, right? And so I think it's very important pitfall that you don't want to get caught up in these fads, because that's a very quick way to lose money. It's a very quick way to disrupt your financial plan. And then you're really going to be stuck. Do you have any points on that one?
Yeah, I would say that kind of relates back to the pitfall number 2 of keeping your emotions out of it. So stop, trying to chase the next big thing or what your neighbor's doing. But as another side note, whatever happened to those NFTs with like the monkeys, people were spending thousands of dollars. It was always on CNBC or these other news channels where buy this NFT, buy this monkey. You can go to parties if you buy this. Like, I just don't know where that went so fast, because it was such a hot topic there.
Good point. It's a straight up a fad. You don't hear about it at all anymore. I'm sure they still exist and they're still out there, but you don't. The key with these fads is you don't want to be the last sucker. You don't want to be the last person to buy something and then nobody wants to buy it from you. And that's the big issue with these fads, and that's where you get caught and you can get into some serious financial trouble by doing that. So yeah, there's just no reason for it. If you want to gamble, I guess, but like, why would you want to buy an NFT as a gamble? Unless, if you're a collector, I guess. But again, it's digital. It's like you can Google anything now and see a picture. You could probably Google the NFT and just see the picture of the same. So why would you want to own it? Just really strange to me. You're 100% right on that. Where have they gone? in there. So you want to be careful. And you also want to be careful. Like, I would almost, though, consider, Matthew, that I bonds potentially are a fad, right? So I bonds are these inflation bonds that they were paying great interest, 9%. Now they're paying around 6%. And I'm not saying that they're bad, but you don't want to get caught up and start disrupting your financial plan to necessarily and go buy I bonds. Like, for example, you wouldn't want to sell a stock that's down potentially to go buy an I bond because maybe that stock will go up. Now, again, this isn't financial advice, so maybe it did make sense, but you just want to be careful. So the point of this is that every piece in the portfolio is there for a reason, and it's designed to align your investments with your financial goals. And you don't want to get caught up in hysteria and rushes.
Yeah, that's a good one, because the I bonds for years they were paying 0%, and now
Right.
they're a little bit higher, but they could always drop back down. So definitely don't put too much in there that you can't afford potentially getting a 0% rate of return in the future.
Yes, exactly. So you got to be careful with that as well. Okay, good. This has been good. So number 5, right? We're already at number 5. We're rolling right along here. Go ahead, Matthew. I didn't want to take your thunder from you.
Yeah, this one's probably two-pronged here. So it's diversification. And the reason I say it's two-pronged is there's two topics of diversification where people can potentially fall into a trap or the pit hole. The first one's diversification with their investments. So if you're concentrated in one stock in particular, or if you're missing different sectors of the economy just because you're invested in one area, and that could be a potential pitfall, because if the market goes up or down, you could really see some big swings in a portfolio if you're not properly diversified across all the different areas of the market. Then I'll say the second part is tax diversification. So we see this quite a bit, Jake, where people have been saving for years, but they've only done it in their 401k, where it's all been pre-tax. And then they go and retire, then they basically have this giant tax bill because they'll be subject to required minimum distributions, and they don't have any flexibility just because that's their only account type. So one thing of tax diversification, you want to try to have pre-tax like your 401k, tax-free like your Roth 401k, then after tax, which you can think of like a brokerage account, a trust, TOD. If you have those 3 different buckets, your withdrawal strategy in retirement will be a lot more flexible. You can juggle your tax brackets. It just gives you a lot more opportunity there.
Yeah, that's really good. You bring up 2 good points. And I think from the investment piece of it, as far as not having all your money in one stock, diversification is also always having to say you're sorry. So the idea is that when we buy a basket of stocks for a client, we don't know which ones are going to go up or down. And that's why we diversify. But occasionally you're going to have some stocks that are way up in a portfolio and some stocks that are way down. And sometimes clients will say, we'll sell all those stocks that are way down. And that doesn't always make sense to us, because by doing that, you would be lowering your diversification. You actually would be taking on more risk, and you'd be potentially missing that stock when it does rebound. Now, we won't hesitate to sell a stock if we don't think there's opportunity for it to grow, or if its dividend is going to get cut or something of that nature, or if fundamentally something changes. But I don't want clients looking at their statements and saying, Jake, these 3 stocks are down, no brainer, sell them, because you're almost always going to have stocks that are up and stocks that are down. And we diversify because we cannot predict the future. And that's why you do that. Same thing with your tax planning. That's a really good point. We diversify from a tax perspective because we don't know what tax rates are going to be in 5 years, 10 years, 20 years, right? We think they're going to go up, but we certainly don't know that. So that's what you're getting at there with having some in pre-tax, having some in a Roth, and having some in a brokerage or tax as you go. So that way you can roll with the tax code as it changes, and you're not subject to having all your eggs in one type of vehicle. So again, very important to remember from a client perspective. Jake's reminding me we're going to have some investments that are up, we're going to have some that are down, and the goal is to have the overall portfolio grow to my target rate of return over time. And then from a tax planning perspective, we want to have varying different types of accounts. That way, as the tax laws ultimately change, we can change your distributions with it. Good one. Good one. I like that one. All right, perfect. So let's do a quick recap here, right? So number 1, have that emergency fund, liquidity, right? You don't want to have to sell a stock. You don't want to get some shady payday loan, right? Make sure you've got enough cash on hand to meet your short-term liquidity needs. Number two, separate those emotions. Don't get caught up in being scared or greedy. That's why you hire a fiduciary wealth advisor like Falcon Wealth Advisors. We're going to talk you off that ledge. We're going to zoom out and we're going to take a look at your financial plan and your investment portfolio. Number three is not saving enough, right? Don't be that person that doesn't have enough in retirement. You've got to work till you're 70 or 80 years old. It's okay if that's what you want to do, but we certainly don't want clients to feel like they have to do that. So save early, save often, don't overspend, certainly in retirement. Number four, don't chase the fads. Matthew, do you have a bunch of Beanie Babies lying around your house?
I don't, but my parents still might have some from when I was a baby.
Fair enough, right? And I take it you don't have any NFTs.
No.
So again, be careful of the cryptocurrency, all that stuff. I'm not saying that it's necessarily bad. I'm saying that it could very well, most of it probably could be a fad. So you don't want to get caught up in that. You don't want to lose your retirement savings because you got swept up under the hysteria of the latest and greatest thing. And then number five, diversify, not only from an investment standpoint, but from a tax standpoint as well. If you have questions on any of these 5 common pitfalls to avoid, certainly don't hesitate. You can email Matthew directly at, is it Tomlin at falconwealthadvisors.com?
Yep, exactly.
Perfect. And my email is simply jake@falconwealthadvisors.com. And we're certainly happy to set up a time to meet with you to go over these things. Also, as part of our practice at falconwealthadvisors.com, we do function as an ensemble. So we've got a financial planning group that you can meet with any of the planners. We've got an investment management group if you want to talk about investments. And then, of course, myself and Corey are available as your wealth advisors. Perfect. As we wrap up today's show, Matthew, is there any other parting comments that you want to leave our audience with?
No, I think we covered all of it. I mean, with these 5 pitfalls, they're hard to overcome. So if you need help, lean on us. But there are 5 common pitfalls just because as humans with our emotion and our behaviors, it's just hard to not do these type of things and fall into these traps.
Yeah, that's good. And that's why you hire us. Again, we're here to help. Don't feel ashamed if you've got a stack of Beanie Babies at home, don't feel bad about it, right? Just recognize that we're going to help you get back on track with your financial plan and get things moving in the right direction. So again, there's no reason to have guilt or shame. We just want to help you avoid them. And if you're in a pitfall, we want to help you get out of it. And that's really what people hire us for. And that's what we're here to do. So perfect. So thank you again, Matthew, for joining me on another episode of Upticks. And thank you to all who watched and listened. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.